Well, guys, it's time that we have a chat about markets because things are starting to get incredibly serious out there. March job reports were bonkers, and on top of that, it means the Federal Reserve is unlikely to cut anytime soon. When we look at the charts, we had the daily 20 moving average breakout, which means that volatility is here, and we didn't manage to get below one of the most important weekly levels. So, on the surface, what's going on? Well, increased volatility is across the board. Bonds are starting to freak out a little bit, and a super cycle is probably upon us. But on top of all of this abundance and opportunities out there, we've got something else that's happening. CTAs dumped big time. Let's get into stocks, commodities, and cryptos for the week ahead. Well, welcome back everybody to The Daily Show. This is our special weekend edition and it's great to have you all here. Remember to subscribe and smash that like button if you love markets like we all do, and comment down below with your favorite stock if we do end up getting a further correction moving forward. Let's go through what actually happened, because on the surface of it, you might think, well, what a great week. Well, actually, it was only good if you were in the right sectors. Now, Meta did very well, but really it was energy, metals, and gold. All of those reinflation plays continued to do amazingly, and semiconductors actually struggled. Let's take a deeper dive at what happened throughout the Friday after the jobs report, and actually what was that jobs report all about. Gold, metals, and everything to do with reinflation was actually still doing very well, and semiconductors came back pretty nicely with Nvidia bouncing off its lows. But when we look at the last 5 days, it really has been all about the sectors we've been discussing, and it may just be getting started for how wild these could get over the next coming years, and we'll talk about that a little bit later on. Just a reminder, we do have an X account, follow in the links in the description, and we post there quite regularly with some interesting charts and many things that you do see on this show, plus some extra things. But the actual result of the non-farm payrolls was super hot, 303,000. And I mentioned over on X that we probably have more work to do, as in the Federal Reserve is going to have to keep rates higher for longer. Now, is this bad on the surface? Well, technically, in a point where we have really low unemployment, that's actually a pretty positive thing for markets. So it's helping the biggest stocks that have cash flow and hurting any stock that doesn't have very good cash flow and needs to borrow in these higher interest rate environments. And where were these jobs created? Well, it was two main sectors, the private education and health services and the government. Now, is this needed to handle the surge of immigration? Probably, but you can see that really the economy was being led by those particular two areas. And here's the monthly change when it comes to the non-farm payrolls. But let's talk about this elephant in the room, and that is commodity trade advisors. Yes, the systematic funds dumped big time on Friday, and the updates that we have here for both the S&P 500 and the Nasdaq show us that they are selling into these new highs or any type of rally at this point. Now, this is completely different to what they've done before, and we just got a new low on the Nasdaq. And what does this mean? Well, it means that we need to be cautious, but also that increased volatility is probably back in these markets. The last time we saw a point like this where we actually made a new low, it ended up being a fairly decent corrective move. So are the CTAs correct? Well, this is the most bearish thing we've seen all year, realistically in the last 6 months, from at least the CTAs on the surface. And today we'll go through whether we've got bullish or bearish characteristics in this market right now. Gold also showing that it's still very bullish on the CTAs. And of course, Brent absolutely going to the moon, which we've already been talking about. And these have been the best trades. Following the money is often the way to go. So what on the surface is happening here? Do we have new breadth? Well, we certainly have new breadth in certain sectors of the markets, where you can see here the energy market has been doing very, very nicely over the last couple of weeks. Also, materials have been doing all right, but breadth on the short term is actually kind of negative when you're taking a look here at some of the other markets. Healthcare, real estate, technology, and consumer cyclicals were all down. And you can see here that this is most likely a rotation that is giving us either a pullback in time or the first warnings of a potential corrective move in the markets. This is very different to anything we've seen so far. So let's talk about commodities and the fact that they've been running pretty hot. Now, a lot of people are interested in this now, while probably about a month ago, no one really cared. That was the early adoption. Now it's kind of public participation, but it could still be in an overall large cycle. Have you ever heard of the lost decade before? Well, lost decade investing is actually a very interesting concept, and we've seen lost decades in arguably emerging markets and also anything to do with commodities and metals. You'll notice here from 2009 all the way through to basically 2020, we had a terrible time for anything to do with metals, commodities, and gold. That's changed in recent years, though. We've now had 4 years of pretty nice upticks in the commodity sectors. And generally speaking, when you get a movement from a low to one of these sustained bull runs, you go on average around 7 years. So is there a lot more to come for this trade? Well, let's have a look at the best trades this year when you're talking about risk-adjusted returns. And if you're not familiar with Sharpe ratio, you really do need to become familiar with it. It's something I talk a lot about in our courses. And the reason why is because it's so important to think about your risk to your reward ratios. Now, did you know that energy is actually the best investment this year, then Bitcoin, then financials, then gold, then crude oil? Notice a theme here. It's pretty much the old economy and anything to do with really anything that's in hedging or possibly, going around the idea that the financial system is a little bit broken. Now, you might say, well, financials are going up. Well, that's because in general, we're being ballooned here by the idea of debt. So debt is a huge thing that's going to really dominate, I think, as well, the landscape over the next decade. And you might see quite a lot of borrowing and in particular, a lot of leverage going into the markets over the next couple of years. When that leverage gets really big, that's when you really want to be terrified. Let's talk about global gold demand by central banks. We already know that pretty much Russia and China are buying up huge. Now, there could be multiple reasons why that is, but I do think that it helps the story for gold. And it probably balloons it to, some big levels over the next 12 to 18 months. And we've already talked about this several times. This chart might be a little bit blurry, but what it shows you here is something that I think a lot of us are concerned about. The idea that the US Treasury interest payments are now sitting at $1.1 trillion. Now, that's a lot of money. And we could bring in what we call debt monetization. And that's going to be a big theme as well, which we'll talk about on the channel moving forward, that I think is going to be a little bit of a concern. Now, you might already say, well, the Federal Reserve already does debt monetization, not in the way that I think could happen. And it is a real risk to markets in the long term. And it could also begin the next GFC if that was the way that we ended up doing it. But for now, it also is helpful for the gold narrative and the commodities narrative overall. Let's now take a look at what we're expecting for the week ahead. So one thing that really happened that I think was surprising last week was we made like that 52-week high and then we dumped off with a closure right on its low. Now, this is unusual. This is actually quite strange. To see a bounce the next day, hey, we know this market is a buy the dip market, so I don't think that's surprising. But when you have a look at the previous results where this has happened, which is often topping markets, then we do tend to go into sideways or even pullbacks after that for the next couple of weeks. So get ready for potential increased volatility across the board. Here's another way of looking at it as well. When we make a 52-week high closing price and the intraday completely collapses to a 10-day low on the same day, less data, but again, can be a sidewaysing market, overall still in a bull run. So the chances of us still being in a bull run, very high. The chances of us getting a little bit of a pullback, it's better than maybe even a 50-50 based on the data right now. So let's take a look at the charts and break it all down. So first up, the big thing I wanted to mention was that weekly 5 EMA. So a lot of people have been tracking the 5 recently, and I don't blame them. There's been an incredibly good bull run over here that was only stopped when the weekly closed below. And you'll notice we didn't manage to do this. So did we close below the daily 20? Yes, we did. Is that a big deal? I think it's a fairly large deal, and it certainly has us saying, whoa, caution, caution, caution. The first time this has happened all the way across this bull run. So was this rally real? Well, let's have a look on the surface. First up, the daily ended up hitting back into the 61.8 level. It also rejected near the close. So if we take a look at the 2-hour, you'll notice that we actually had a little bit of selling that came through here. And this is what we call market structure that's starting to form in this level. We can go over to the futures market action to understand a little bit better. And when we go down through the timelines, you'll notice here again, the structure was formed at the 61.8 fib or the golden pocket, and that this is also getting close to that most traded zone. 5200 also turned out to be one of the biggest options levels on the 0 DTEs, and it is again incredibly important this week. So if we take a look here, Monday and Tuesday both have what we call put supports on 5200. Where are we going to open? 5205. So this is suggesting that if the markets do end up selling throughout the Monday or the Tuesday, that they're going to be in a negative gamma environment and they're going to need to be hedged. Now, as we mentioned in the last video, we talked about the idea that 5150 in particular was actually put support, and that this was a level where if it broke below, then we're probably going to 5100. But non-farms came out, and on the surface, it was a very hot number. Obviously, that pushed interest rates up across the board, but it did the classic little fake out, went one way, and then went the opposite. So where do we find ourselves at? Well, unfortunately, it's neutral, and that's because we know that we're in a bullish trend overall. We know that the daily 20 moving average obviously was closed against, and we have to wait and see how the Monday ends up opening. Because again, if it cannot hold the 5200 level and we get movement underneath that, it really pushes us to that 5150 zone. So let's have a look at the options to understand that a little bit better. Here are the options, and we can see that there is a lot of 5200 puts sitting there. Now you might say, well, this means it's bullish, the market has to go up. Yep, it is a base. It's what we call a put support or a put wall. Now, if the market goes through, next logical conclusion is to get to 5150. Not only is that a technical support now, because it's what we came off, but it's also the Tuesday's most traded zone. So this week is going to be dominated by 0DTEs. Remember, it's also CPI week, which means that inflation's coming out. And then at the end of the week, we have earnings season kicking off. So the vol is going to get really big. Absolutely, there's going to be huge day trading swings. And even if we go up, the markets are still probably pointed towards being very sidewaysy for a little while here. And let us explain why. First up, election years. We know the seasonal pattern is sideways at this point. We also know that when we look at the most correlated charts, which I've been banging on about, but I think it's pretty important, which is 2012 and 1976, that we tend to see pullbacks in time, which is sideways, or even pullbacks in the markets. And because of the increased vol, because of the bonds, because of this reinflation play, it makes the most amount of sense. And it really backs up with a lot of the other stats and figures we've been talking about. Semiconductors being weak during April and amazing during May. Hey, it could be a pullback. The fact that we're in a secular bull market, which means that good things are probably going to keep coming for markets. But that we also see in general with all of the synergies across the board, pullbacks in time around these points of year. Now, that's not to say that you need to be terrified as an investor. You're probably not going to be terrified, but would you have some powder dry for the potential here? Yeah, I think it could be possible, or you'd be rotating into the best areas. Let's take a look at earnings season then. Earnings season revisions for 2024 have been above average. In fact, they've been pretty damn good. The market is loving life and it is expecting further growth to come. But Q1 is expected to be slower and a little bit weaker. You can see here margins are expected to trough in Q1 before rebounding later this year. So really, most of these expectations are actually based on later on this year, things getting good. So what might be the problem is not even maybe the earnings results themselves, but actually the forward revisions. So will we get forward revisions that support this idea that the market has, or are they going to be a little bit weaker? And this is where you're going to get that implied volatility coming in and real opportunities as investors, swing traders, day traders. I really think this earnings season is going to be a very good time for people in the markets. You can see here Friday kicks it off with all of the big banks, and the implied volatility is always really important to understand. So the market is expecting that most of the banks are going to move between kind of 4% to even upwards of 6%. Now that's pretty big for banks. So we'll be watching the XLF sector later on this week to have a look at how it's trading into the events themselves. It's been very bullish recently. Also, the largest S&P 500 stocks are going to be driving this market. Here are the ones that are pretty much Wall Street across the board is loving the most right now. It's Nvidia, it's Amazon, it's Meta, it's Google, Berkshire Hathaway, and of course, Broadcom and a few others. Now, it may not come as any surprise, but these stocks will be very important when it comes to overall weighting from the markets. And you have a bank in there, so if that bank doesn't perform, the markets might not like it straight up. 2024 bottom-up consensus EPS revisions. Again, the top 10 is where most of the growth has been coming from. And the overall 490 stocks are not getting that revision increase that you would usually expect. Here are the ones that you want to be watching. Market capitalizations. JP Morgan kicks us off here on the 12th. So remember, 12th of April, it's going to be an important event, and be watching those banks across the board. Another thing that we need to look at is, of course, options and the CPI pricing. We know that CPI has been priced in quite a few times, but we're getting back to the point here where the Russell in particular is getting a little bit shaky based on the CPI overall. And that's because higher for longer really dominates those stocks. And there's like 35% of these stocks make no money. So high interest rates for longer, that's kind of bad for them. And this will be probably the chart that I think most people will be watching. We've got some great levels coming up in today's show. Let's also talk about high yield bonds. Of course, risk on and risk off. We didn't break through realistically that 76, 77 level yet, but do remember that's where all the puts are. So we've got a put wall holding up the bonds market for now, because arguably junk bonds are the most important at this stage in terms of risk on, risk off. If we manage to get through a 76 in particular and close below, that's most likely going to need to be hedged off. And again, I think it's a very negative thing for markets. So watch high yield bonds this week and coming weeks. We also know the VIX managed to hold above that 15, 16 level. So that's signaling that we're going to have a lot more vol, and CPI day and of course earnings season kickoff are bringing all of that. So let's deep dive into the charts together. We'll start off with the VIX here, and we all know 16 is a huge closure. The highest close that we had since the last sell-off, which happened realistically back in October of last year. And this means that vol is spiking. Now, because we have inflation, we have earnings season, and we have a whole bunch of minor news coming out this week, it's going to be very important to continue to watch the VIX. And we know the short vol trade is starting to get pressured. So what people have been doing recently is selling puts. In particular, this has been one of the best strategies of the last kind of 6 to 12 months, other than being long in markets. And last week, we noticed that we had options, in particular for bonds, starting to spike back up. Now, this suggested that there was something unusual about to occur. And then we ended up getting that massive sell-off that closed down on its lows. Now, is that a big enough deal to be like, oh, I'm out of the market, I'm just going to stop being an investor? Of course it's not. But that coupled with what we'd already been seeing, which is a trend of both the Federal Reserve and central banks around the world dropping their overall support for the markets, and this is the liquidity of the markets with a whole bunch of different calculations underneath, it's kind of showing you a weaker story than we've had so far throughout this entire rally. We also know that volatility is spiking because the US 10-year, the US 2-year, 5-year, 20-year, all of them are definitely closing towards new highs. And it's the new reality of higher for longer that the market's starting to see. Now, on one side, you're saying, okay, earnings are robust, things are looking good. But guess what's just about to kick off? Earnings season. Again, the markets are going to be looking for those new revisions, those higher expectations, although they don't have that many high expectations for Q1, to start kicking in. So I think the forward guidance is again going to become one of the most important levels. And individual stock selection and sector rotation continues to be our favorite thing here on the markets. And it's been incredibly good, especially since the January, February kind of period where we started to see some movements into other sectors other than just semiconductors, which are usually the first go-to. High yield junk bonds, they're coming under pressure. Remember to set your alerts at 76 and 77 for the week closure. As you can see here, we're just in between those two zones. So if we end up getting below 76, we've already demonstrated that is a put wall. If markets get through there, it kind of undoes the pinning of options. And then what's going to happen here is the puts are going to need to be hedged off and the markets will push down. So for now, the support is certainly at 76 for high yield junk bonds. But if it manages to drop and close the weekly below, it might be a couple of weeks of sell off and then hopefully we resume the bull trend. What about home builders? Well, home builders also were coming under pressure last week, arguably falling below the 20 moving average for the first time. A high, a low, a higher high, and then a lower low has a first time frame, what we call change of trend on board. And we've had one of these before that ended up pittering out. So we're looking for more signs here from home builders. Ultimately, the S&P 500 is going to be the best drive. But remember, if home builders start suffering and then the S&P 500 goes through, it tells you that the market was already internally weak because home builders have been driving this market a lot other than semiconductors. What about the US dollar? It closes as a long leg doji. And we all know what this means, indecision or equilibrium. It's pretty frustrating when you get these types of points because you've got a high, low, and an open and a close pretty much at the same levels. And it means that it's confused. What's the next move for the dollar? Based on yields breaking out, you would think dollar strong. Therefore, 105.50 remains the more likely situation, but it is a long leg doji, so we'll be looking at smaller timeframes to really kick in better trades. If you were looking at trades, though, you'd generally be long here with stops below the low. it's not the best, but you can see it's also come off the supply up here. But I'd say it's more bullish than bearish on the charts at this stage. Copper is, of course, a strong bull kind of market, along with most of the other metals. And copper, we're looking for a 440. We've been bullish for this for quite some time, and the markets broke out the other day with another resurgence in the copper trade. What is even more surprising, though, is how well gold has been doing. I mean, I'm a big gold fan at the moment, and I think it's going to go to something like $3,000, but it just held through last week as well. 2,300 was the flag overall take profit zone. So if you did take profit there, I wouldn't be upset from a trade perspective. But from an investor's perspective or a longer term hodler, this is looking pretty good. And with the geopolitical risks, as we stated before, and also the possibility of a commodities super cycle that I've also been discussing in our Monday macro group that we do privately, if you're ever interested, 7-day free trial down below. This has been a very, very big kind of play, and gold has been bullish for quite some time in that. Silver squeeze trended last week on X. We also saw a huge amount of people start to get bullish. This was in our last weekend video, and it's getting close to its first target. But if you go out, silver has a lot of catching up to do before it gets back to those all-time highs. In fact, if you actually look at silver, we're not even close to the period where we were during 2020. And then you go back even more history and you get into those magical 46 levels and 48 levels that were last hit in the 70s. Silver's been a horrible investment for so long. But what an interesting base, and certainly a great inverse head and shoulders. Ultimately, a series of higher highs and higher lows, and a decent base across the board for the precious metal. Now, it's not rare, so just remember silver, I don't expect it to do as well as gold in the geopolitical risk space, but it's still coming along as a trade. Gold stocks, they're still super underpriced. One of the things that you can always do is look at GDX versus gold, and then you'll see that gold has been way outperforming gold stocks up until recently. And we spoke about this low. And since then, gold stocks have outperformed gold 11.4%. It's actually a little bit more than that, but since we pretty much started talking about it, it's about 11%. Now, it's been a great trade. You can see volume increasing. I think there's more in this kind of trade, but again, it's going to take quite a few months to play out. US oil, very strong from it. Goldman came out with an 87 target. It hit it the same day. I don't know why you have a target like that, but 87 target. We have, of course, 88 on the mind. And then past that point, you're talking about those 92s again. So 92 is possible. Where it hit last week, I wouldn't have blamed people to take a little bit of profit off. You can see we've got an 88 target though, and then 92. So oil still in the bullish trend. It's very bullish to close above, of course, the weekly pin bar rejection that's here. And it just shows that you shouldn't use pin bars purely as your analysis. You've got to use other methods. And this pin bar had no follow through. So because it never made a lower low, that's a good sign never to get involved in one of those trades. So next time, top tip for this week is if you are trading pin bars or hammers or shooting stars, like this one here, make sure it makes a lower low or a higher high. Follow through is very important. Energy stocks continue to rip. People have asked me, what do you think about energy stocks? Well, they are probably a little extended, but when you're in a bullish trend like this, it's kind of like the market. You keep following it until it gives you a reason to be terrified. So recently we saw something similar with semiconductors, where semiconductors kind of blew off the top. And we've also had it in some other stocks recently as well that have kind of ended their trend for now. And now they're going into consolidation. Now, I do think that energy stocks should be going towards that 100 peak of 2014. So it looks like they've got a little bit more room above. So from energy to metals and mining, still really bullish on the metals and mining industries. You can see here they're rallying, they're looking really nice. And in general, I would say XME is just primed for further gains. And of course, if we are in a super cycle for commodities, this is the type of one that you'd be looking at. If you zoom out really far and you look at metals and mining in the past, you'll notice it did hit super peaks during 2008. And a lot of people never go back and look at this. I mean, look how expensive things were in 2011 and 2008. It's amazing how we complain about it so much now, but it was actually more expensive back then. So really metals has been suppressed for a very long time. Semiconductors, something similar here. You can notice that semiconductors have been going sideways. This is pretty normal. You get these huge runs, you get consolidation, you get huge runs, you get consolidation. We do know that this is a month of theoretical weakness for semiconductors, and it's leading into some of the bigger calls that we've had recently, which has been SMCI sideways to down and NVIDIA sideways to down coming through. A lot of retail traders, unfortunately, getting left holding the bag up here. And one of the things about Nvidia is, imagine if it takes out these lows. You think you put yourself in a position of someone that accidentally bought up here. Now, long term, that'd be fine, I'm sure. But if you're a short-term trader, where are you going to put your stop losses? Here and here. So imagine if it gets down to those points and then wicks back up. You probably know it's a trap and they may be the catalyst. So for now, pullback in time is happening on Nvidia, and that's pretty normal. Again, kind of what we expected on the channel. Tesla, now a watch reaction here was hit, and I don't put too many of these on charts, but this was a nice little low take, and it was not a bad little day trade if you wanted to get a little bit scary with it. Ultimately, Tesla is coming under the fire line of downgrades. Elon's getting grilled. Everyone's getting grilled. The weekly close was still above the overall first position. So if you've been watching the channel over the last couple of weeks, we talked about how this had a massive, big transaction on it, and that's being defended. So someone is buying this zone. Otherwise, it wouldn't be able to spike back up. Weekly closure is not great, but it is still holding. Now, if we get through this alert up here at the yellow, at the white line and above the yellow, that's probably going to signal that Tesla's ready to go again. It is still in a downward trend, but I can see people accumulating it here. So they're trying to accumulate it. It may not be the end, though. A lot of you post in the comments you believe it's going to 122 or 112 or something like low. It's certainly possible. And at the moment, it hasn't really shown the full signs of turnaround, but I think day traders are trying to buy that support. For the indices around the world, we've still got the Hang Seng, and I've been going on about it for a while. It's holding up pretty well considering the markets around the world, and we're looking for a 17,000 break close above, which should signal further movements into the Chinese markets. Again, we like the biggest tech stocks, the big data tech stocks. I'm not partial to Baba, but the other ones like Tencent and others are actually doing quite well. So if you have a look at Tencent, for example, Tencent's actually broken through a few weeks ago, about a week ago, and it's continued to strengthen. So this is one of the more popular tech stocks in China. It's doing all right. US 2K, it's the same thing, except it's on the bottom end of the ascending channel in this case. We did bounce, which is great news for buyers. Volume was obviously up through the previous session, which is important as well. But when we go down to the 2 hour, I think there's a little bit more room to go for the bulls. So did we take a lower low? Yes. Have we now gotten through this level of supply? Not yet. I would probably cease fire in terms of thinking too much about day trading on the upside until IWM's able to get through here. We obviously had that closure, which was pretty much clearly false because it was sucking in buyers. But we remain to really the upside on IWM, even in the higher rates for longer environment, especially if this occurs. So for day traders, they're going to be looking at that 2120, 2115 kind of breakout and hopefully holding the ascending channel. If it isn't able to do this and it breaks below, let's say this last low of around 2000, 2010, then yeah, that could mean the deeper pullback is coming. So watch the Russell. It's going to be an important chart to check out this week. The Qs as well, they still have technically an island reversal on them. We have a gap up, we have a gap down, we have a massive vol spike down that closed in its lows. Now, generally when that occurs, we get rallies. That's not uncommon, but the rallies usually are met by sell demand. I still think this is a very strange candle. Now, you might say, but Tom, we've had many of these sell-off candles in bullish runs. Well, let's just go back and have a look at the previous periods in time. Specifically, we'll go to the 2020 rally, because of course, 2020 rally was pretty big. Now, when we got these big red candles, they generally did rally. There's one that rallied and it ended up selling off. In terms of another big red candle, this one just sold off, gave us a little bit of a correction. And then there was this big one here that came out of nowhere. Now, what happened after that? It rallied and then it ended up selling off. Now, this is a much deeper pullback than I expect, but the point is that these huge candles that come out of nowhere, there is one over here, by the way, especially if they're near the highs, that is, they're right on those 52-week highs or those highs in general, e.g. here, and in many ways over here, they do matter. And because we've been consolidating or pulling back in time recently, the next breakout, the break underneath the low, so that is if we take these lows out here, that's going to show us that we're most likely just distributing and we're moving towards a nice correction. Now, if we end up finding here and then bouncing through, the breakout most likely will be real and we'll probably continue on. I think earnings is going to take us through this point, or maybe an inflation level. But yeah, lots of day trading, lots of options. I'm looking personally at the S&P 500 the most to give us the guide. And you'll notice that the Qs also closed underneath the daily 20 for whatever that's worth. Let's have a look at Bitcoin. Bitcoin is in the middle of nowhere land, and it has sellers here and buyers basically at 66K. So I can see why people would buy here. I can also see people selling here. For clear buying opportunities, it's going to be above 72 for a new all-time high. And basically for sellers, you're really going to want it back down at 63. You could start to preempt possible 60K movements then. And the halving is just a few weeks away. So it's not long now until the halving. Some people have done studies on it. Turns out that in most halving circumstances, we end up selling off first at around 30%. Will it happen this time though? Circumstances are different. I think that it's fine to be probably a little bit on the sidelines if you're a trader of Bitcoin. And if you're a hodler, then I think you've got much greater plans for this 100K plus, I'm sure. For the news for the week ahead, we've got CPI coming out on Tuesday at 8:30 a.m. Wednesday at 8:30 a.m., 10th of April. And then we have the FOMC meeting minutes coming out at 2 p.m. on Wednesday. So that's a massive day. And then on Thursday, we have even more information coming out around the world. So it doesn't stop. It's one of those massive weeks of news, which all increases the chance of vol spikes and increases the chance of 0DTE mad action. So make sure to subscribe to the channel if you are interested in finding out more about those kind of wild actions, and follow us on the socials down below as well. And we'd love to see you there. Thanks very much for watching, and we'll see you in the next one, guys. Have a great weekend. Bye for now.